Picture this. You wake up early every day, you fight traffic, you work 8 hours a day, and yet every month when the rent comes due, $1,800, $2,000, maybe more, you feel that butterflies in your stomach. Now imagine the opposite. Imagine that without having to work anymore, you start receiving money every month directly into your account. It's not a bonus, it's not a tip. It is your share of the profits of real companies listed on the American Stock Exchange. This is the power of monthly dividends. When you buy shares of companies that pay dividends every month, it's like you're investing in money-making machines while you live your life. And the best part? Some of these companies have decades of history behind them, paying without fail. But here's the scariest part. While thousands of Americans spend all their income live paycheck to paycheck and wait for Social Security retirement, there are people financing their own rent and building financial freedom with just monthly dividends. The choice is simple. Do you want to continue depending on your boss, or do you want to start building your own income machine? The answer could change your life, literally. Now that you understand what monthly dividends are, you might be wondering, okay, but why would I invest in this instead of saving my money or buying more famous stocks like Amazon or Tesla? Simple. These companies may grow, but they don't pay you anything while they do. You only win if the share price goes up, and you hope to sell at the right time. But monthly dividends work differently. They pay you every month with or without appreciation. It's like a second salary that doesn't depend on your boss, the economy, or luck. Want an example? Think about your electricity bill, rent, or health insurance. They come every month without fail. Now imagine if, along with them, came a monthly payment only yours, coming from your investments. This type of income makes all the difference for those who want. Get out of financial trouble, have more freedom of choice, or retire early without waiting for the 67 years of Social Security. And there's more. These monthly payments can be reinvested. This means that the money you receive can buy more shares, and those new shares will also pay you back, creating a snowball effect. While most people still live in fear of the end of the month, whoever understands this begins to live safely at the beginning of the month. And the best part? You don't need to be a millionaire to get started. You just need to know where to put your money, and that's exactly where the next point comes in. How to pick the right stocks and avoid the bad ones. Before you go out and buy stocks that pay monthly dividends, you need to understand how to choose the right ones. Because yes, there are a lot of traps out there. There are stocks paying 18%, 20% per year, and it seems incredible until you realize that the company is sinking and won't sustain that payment for long. So to avoid throwing money away, you need to analyze three things. The first is the dividend yield, which is the dividend yield in relation to the share price. It shows how much the company pays you per year. For example, if a share costs $100 and pays 5 per year, the yield is 5%. So far, so good. But if the yield is too high, like above 15%, it is a warning sign. It could be that the share price has fallen too much because the company is doing badly and it is using a dividend to attract unsuspecting investors. The second thing is the company's stability. It has to be a solid company with a business model that generates cash every month, even in difficult times. Companies with a history of constant payments, without delays, and with consistent profits. If it has survived crises and continued to pay, point for it. These are the ones you want in your portfolio. And the third point is the growth potential, because it's not enough to just pay you now. You also want the stock to appreciate over time. That's where the power of compound interest comes in. You receive dividends, reinvest, buy more shares, and over time, your monthly income increases on its own. Your money starts working for you. So, to recap, balanced income, stable company, and growth potential. If a stock has these three things, it has everything it needs to become a reliable source of monthly income. And in the next step, I'll show you exactly which 6 stocks do this and how much. You need to invest to literally make these stocks pay your rent every month. The first on the list is Stag Industrial, and if you don't know this company yet, pay attention, because it is one of the favorites of investors looking for stable and predictable passive income in the United States. Stag is the code name for Single Tenant Acquisition Group, and it operates as our REIT, one real estate investment trust. That is, a real estate fund that you can buy directly on the stock exchange as if it were any other share. But Stag's big difference is where it puts its money: logistics warehouses and industrial centers spread throughout the American territory. And why is this so strategic? Because we are living in the era of commerce. Companies like Amazon, FedEx, UPS, and many other retail and logistics giants increasingly need physical space. Warehouses, distribution centers, logistics hubs. Every time you click buy on your cell phone or computer, there is a machine working behind the scenes. Someone needs to store that product, separate it, package it, and ship it to your door. And that's exactly where Stag makes money. She buys these industrial properties, rents to these companies, and receives monthly rent. Most of the contracts are long-term, which ensures revenue predictability. In other words, it makes a profit even when the economy fluctuates. And this makes it a cash-generating machine, or rather a cash-generating machine. Pay dividends every month directly to your account without you having to do anything. The Stag's current dividend yield is 4.23% per year, which may seem modest at first glance, but remember, we are talking about a company with very high stability, very low risk, and a solid history of growth. Since going public, it increased the number of properties consistently, surpassing today the mark of 500 industrial warehouses spread across 40 states in the USA. This brings a level of geographic diversification that protects the investor from localized shocks such as regional crises or specific problems in certain cities. And what's more, Stag keeps growing. Every year, it reinvests part of the profits in the purchase of new properties, which generates more revenue, more profit, and of course, more dividends for the investor. This is one of the main reasons why it has increased the price paid per share several times over the last decade. And all this with a highly professional and transparent management, which is essential when we talk about rates. Another point worth highlighting is that Stag warehouses are considered essential assets. In other words, even during times of crisis, as happened during the pandemic, the demand for this type of property did not fall. On the contrary, increased, precisely because of the explosion in online shopping. This ensured high levels of occupancy, with renewed contracts and even rent increases in several cases. In summary, Stag Industrial is that solid foundation that every passive income investor needs to have. It offers a powerful combination of security, consistent monthly payments, and real room for growth. Ideal for those who want to sleep easy, knowing that their money is working in real properties, rented to real companies, with firm contracts and total revenue predictability. Next on the list is Realty Income, a true legend among investors seeking monthly income in the United States. Known as the Monthly Dividend Company, that is, the Monthly Dividend Company, or it is practically synonymous with regular and secure payments. Why? Because Realty Income has an impressive track record. It has already paid more than 600 consecutive monthly dividends since its foundation, and the best, increased the value of these dividends more than 100 times since it went public back in 1994. This is something that few companies can achieve. Imagine receiving a check every month religiously for almost 30 years. Its current dividend yield is around 5.08% per year, slightly larger than Stag Industrial, and it invests in thousands of commercial properties across the country. But these aren't just any properties. We're talking about buildings leased to big, solid brands like Walgreens, FedEx, Walmart, and many other names you know and trust. This means Realty Income has very stable leases with companies that are unlikely to default. Additionally, Realty Income has a track record of consistent growth. In 2021, the company made a major acquisition of REIT, another major REIT, which added approximately $6 billion in properties to its portfolio. This not only increased cash flow, but also further diversified the tenant base and industries served, making the business more resilient to economic downturns or market shifts. As a REIT, realty income is required by law to distribute at least 90% of its taxable income to shareholders in the form of dividends. In other words, you, the investor, directly receive the fruits of the company's performance, and with the quality of a management team that knows exactly what they are doing. Now think about the impact this has on your life. Having a share in realty income guarantees a predictable monthly income which can cover everything from your basic bills to your rent, or even be reinvested to multiply your assets. It is a strategy for those who want security, predictability, and growth without having to depend on the volatility of the traditional stock market. Great. Now let's talk about the third one on the list, Oxford Square Capital Corporation. Here things get more interesting because its dividend yield is much higher, around 13.5% per year. But don't worry, this also means a little more risk, so it's for those who are willing to seek higher returns and understand that this comes with an extra dose of attention. Oxford Square is what we call Business Development Company, BDC. That is, a company that works like a specialized investment fund, looking for opportunities to invest in smaller and medium-sized businesses in the United States. It is not a REIT. It does not invest in real estate, but in companies that need capital to grow. These are businesses with annual revenues generally below $200 million. These are Goldilocks businesses, not too small to be unstable, but not so big that they depend on large traditional banks. Oxford Square's strategy is to identify promising companies, invest in them, and help them grow in exchange for interest and profit sharing, which generates solid income for the company and, consequently, for you who invest in it. It is a type of investment that, if well chosen, can offer very attractive returns, since these companies often do not have easy access to bank loans. However, as this is a more volatile segment, investors should be aware that these dividends can vary more, and the value of shares can also fluctuate significantly. Therefore, it is important to diversify and, if possible, talk to a financial advisor to understand whether this option makes sense for your profile. But the good news is that with this higher return, you can greatly accelerate your goal of having a passive income that pays your bills, including rent. Plus, Oxford Square offers an indirect way to invest in American small and medium-sized businesses, which are the backbone of the U.S. economy. Great. Let's move on to the fourth on the list, Orchid Island Capital Incorporated. This company is a specialty finance company, that is, a specialized financial institution which operates mainly by investing in securities backed by residential mortgages in the United States, known as residential mortgage-backed securities, RMBS. What does this mean in practice? Instead of buying homes or buildings outright, Orchid Island buys these bonds that represent the repayment of loans taken out by people who bought their homes. When the homeowner pays off the mortgage, Orchid Island receives a portion of those payments as revenue. Its dividend yield is quite attractive, around 17.3% per year, but it is worth remembering that we are talking about a type of investment that involves more risks, mainly related to the health of the real estate market and the default rates of residential financing. Therefore, it is an investment that can be more volatile. On the other hand, the company is committed to distributing at least 90% of its taxable profit in dividends, ensuring regular payments to investors, which can be a great source of consistent monthly income For those who want to enter the real estate market indirectly without having to buy a property, Orchid Island Capital can be an interesting gateway. It offers exposure to the real estate sector and, at the same time, a high monthly income, which is a great help for those looking for a steady income to pay their bills. Okay, now let's go to the fifth on the list. ARMA Residential REIT. ARMA is a REIT that specializes in residential mortgage securities guaranteed by the U.S. government, known as agency debt. These securities represent home loans that are backed by major federal agencies like Fannie Mae, Freddie Mac, and Ginnie Mae, institutions created to ensure the stability of the U.S. housing market. This means that even in difficult times, these securities have a strong government backing, which reduces ARMA's risk of default. But why is ARMA's yield so high at around 18.5% per year? The answer lies in the structure of these bonds and the associated interest rates. Despite the collateral, these bonds offer attractive interest rates, and ARMA is able to turn these payments into a steady stream of dividends for investors. Furthermore, as a REIT, it is required by law to distribute at least 90% of its taxable income as dividends, meaning that almost all of the money the company earns goes to you, the shareholder. But be careful. This investment is not for those who just want absolute security. High profitability comes with significant risks, mainly related to the volatility of interest rates. When interest rates rise, the value of mortgage bonds tends to fall, which can affect ARMA's share price in the short term. In addition, changes in the economy that impact the real estate market, such as changes in the default rate of borrowers, can also influence the company's results. On the other hand, for the investor who understands these risks and is willing to accept this volatility, ARMA offers an excellent opportunity to earn a consistent and high monthly income, the kind of money that can pay everything from rent to other fixed expenses without having to touch the principal invested. In short, ARMA Residential REIT is a strategic choice for those who want to earn a solid passive income from real estate, but without buying properties outright. It's a smart way to take advantage of the residential mortgage market in the United States, with monthly payments that can make a big difference to your personal cash flow. Okay, now let's move on to the sixth and last on the list, the San Juan Basin Royalty Trust, SJT. This is the most unique of all, and also the one that offers the highest dividend yield, around an impressive 22.5% per year, a number that draws a lot of attention, but that requires care and knowledge to understand the risks involved. The San Juan Basin Royalty Trust is a depletion trust, that is, a fund that manages fixed reserves of natural resources, in this case, oil and natural gas, located underground in the United States, specifically in the San Juan Basin, which is a region rich in fossil fuels. Here, the income for the investor comes directly from the extraction and sale of these resources, that is, as oil and gas are extracted from the ground and sold on the market, the trust distributes the profits to shareholders in the form of dividends. The energy market has been very favorable recently, with high oil and gas prices, which has increased payments made by the San Juan Basin Royalty Trust. In addition, the company has sold a significant portion of its reserves, further increasing cash flow to investors. But be careful, this type of investment carries some very specific risks. First, the reserves are limited and finite. Unlike a company that can grow and expand, the trust depends on what's still in the ground. As oil and gas run out, the value of the dividends tends to decrease, which can affect the income you receive over time. Furthermore, oil and gas prices are highly volatile and subject to external factors such as geopolitical crises, changes in global supply and demand, advances in renewable energy, and environmental policies. These variables can cause large swings in dividends and stock prices. So, investing in the San Juan Basin Royalty Trust is like investing in the fossil fuel industry, a sector that, despite environmental challenges and pressures for energy transition, still generates significant profits and can provide a high monthly income for those willing to accept the risk. For those looking for a robust passive income with the potential for high dividends but understand that this can be volatile and temporary, SJT can be a strategic piece in the portfolio. Now, let's find out how much you would need to invest to earn $2,000 a month, that is $24,000 a year, with these 6 stocks we talked about. First, let's calculate the average annual income of these companies. Stag. Industrial tem 4,23%, Realty Income 5,08%, Oxford Square Capital 13,5%, Orchid Island Capital 7,3%, Armour Residential REIT 2,5%, is San Juan Basin Royalty Trust 22,5%. Adding it all up, it comes to approximately 81.11%. Dividing by 6, the average is around 13.51% per year. To find out how much you need to invest to generate $24,000 per year with this average, just divide 24,000 by 13.51%. That's about $177,600. In other words, by investing approximately $177,600 divided between these 6 shares, you can receive, on average, $2,000 per month in dividends. Remember that this value is an average and may vary depending on the performance of each company, but it already gives a good idea of the amount needed to have this passive income. So, what do you think about these 6 stocks that can pay your rent every month? Remember, investing in monthly dividend stocks is a powerful way to build passive income and gain financial security. Of course, always do your research and understand the risks before investing, but with discipline and a solid strategy, you can turn your money into a steady income source without having to work harder. Start small, keep learning, and focus on the long term. Your financial future will thank you. Don't forget to like the video, subscribe to the channel, and hit the notification bell so you don't miss the next tips. See you next time.